Alright guys, welcome back to Roxim TV and also welcome back to Gems and Crypto. Whichever platform you're watching on, I really do hope you guys are hanging on tight because I hate to break it to you. During this 1.5 hours long session today, I only have bad news because we know yesterday we actually covered on Roxim TV as well on yesterday's show. So we know the labor market, we got some data, although it has been delayed due to the shutdown. And well, we finally got the September number. Looks like on the first glance that it looked well, like it as a nice report. Like there are many jobs being added. We're talking about like more than 100,000 of jobs being added. However, if you dig deeper, there's also a job revision. So what happened yesterday during Hong Kong nighttime? Because of course I was like looking at the news, looking at how the world is doing, and S&P 500 immediately reacted positively to the news. Bitcoin vice versa, we experienced a huge dump, like even a bigger dump, but that's fine. However, if we dig deeper into the data, we know there's also a job revision, so a downward revision, especially in August. Like August jobs like non-farm payroll, the jobs being added was not nice to begin with. Like it was a positive number at start, so 22,000 jobs being added. But like because of yesterday, we have a downward number. We have a revision. So August turns out to be a negative number. In other words, like jobs are being reducted. So it's being reduced from the market. That's not a nice looking report. And we also know the unemployment rate is slowly ticking up. So this is just the labor market and what it shows yesterday. And on top of that, we also have some Bitcoin whales. We are talking about dumping billions of dollars, so more than 1 billion actually, onto the market. Because I don't know, like, why do you need $1 billion? Like, it makes sense if you want to slowly cash out like a few millions here or there to purchase a mansion, but like dumping $1 million in less than 2 months, well, basically 1.5 months, that's something. Maybe I'm too poor to understand the mentality of a billionaire, but that's definitely interesting. And that is adding a lot of pain to the market. Well, I wouldn't put all the blame on this one whale alone, but it's definitely not a fun time watching the chart, watching the labor market at the same time. All right, and we also going to dive into Japan today because one thing we learned is that the 10-year bond yield of Japan is skyrocketing. This is actually really, really concerning. And we're going to look through Japan because Japan has it's almost like a crystal ball in terms of where the US economy is going. Japan is always front running the US economy by usually a decade, so 10 years, somewhere around that, a few years ahead of the US. So what we're going to do today is really dive into the Japanese economy and what we could take away and learn from that. And maybe US, we could avoid being a recession. But even though if we are actually heading for a recession, I'm sure the US government would avoid that because basically calling it a recession is illegal now. But anyways, there's a lot of macro to dive into. Let's actually start with the Bitcoin chart right now. So we are starting from the daily chart. As you know, my show, I like to do a little bit of TA and then we're gonna dive into the news analysis in a bit. So starting here with the daily chart of BTC, again, is breaking some major support. We are sitting at 84 $84,000 right now. And we actually broke through the rectangle that I drew a few days ago. So this region is between 89K to 92K, somewhere around this. And the last time we actually broke below this region, so we are trading below, that was actually back in February. So in other words, like 9 months ago. And we break this major support that we tested 9 months ago. Last time we trading inside this, like, I mean, below this region, we spent like 2 months. So 2 months underneath this region. But I hate to break it to you guys, looking from this chart, like judging from a TA perspective and also taking into account of the 4-year halving cycle, looks like we are on a downtrend and we're not getting out of the wood anytime soon. So in other words, there will be more pain ahead. And bear in mind, I have been bearish like ever since we hit that 126K because we are forming this major downtrend in the coming days. Or maybe in the coming weeks, I won't be surprised to see Bitcoin having this like dead cat bounce. Like although even reaching this critical levels, it looks like a bit of a difficult task for Bitcoin to do, but I do expect a dead cat bounce. And well, when I see that, I do think it's a good opportunity to pull some trades. So I'm gonna share my strategy for this bear market. Like I personally, I'm not afraid of bear market, and I love bear market quite a lot because bull market is really fun. Yeah, I'm always addicted to the screen, just really curious how high Bitcoin would go. But like bear market is when you make generational wealth, is when you can actually buy a Bitcoin at a cheap price, and I'm very looking forward to it. Right now, 84K is just a fair price. It's not cheap. There is more pain ahead, and I'm actually quite excited for it. But anyways, let's go back to this downward trend. Right now, 89K and 92K, this region is acting as a major resistance. I don't have much conviction that Bitcoin would be spend too much time trading inside this region yet get above it. But like if we do get a dead cat bounce, maybe we trade inside a little bit. Like my strategy right now is that okay, if there is any altcoins that I haven't got out, it's a good time to get out, and maybe I will short a little bit of altcoins. But of course, it's not financial advice. I'm just like sharing my strategy, my brainstorm idea, just brainstorming here. But like, here's what I'm gonna do, and that's what I've done in the previous cycles as well. So yeah, I mean, it's a really fun time because I love trading, and I'm very addicted to the chart. So one strategy that I'm planning to do is that when we see a dead cat bounce, I'm going to get out of the spot position of altcoins because like altcoins going to bleed against Bitcoin even more. This is almost a formula that we know. So I'm really surprised how there's so many influencers out there calling for an alt season, and there's like on-chain analysts saying that it's just a local bottom and the best time is still ahead of us, because that's not what reflecting on my chart. I just trust what I see. I just trust data. And so here's one strategy. And of course, the other one is just like I could spot trade. So when Bitcoin get down enough, because like right now we broke this major support of 89K. So this region, this little box. And I do see the next support that we have is around 70K. So 70 to 72K, that is the major support. Like here, we don't have like much data going on. So we're on the daily, of course, but if we zoom out on a weekly, here is on the 2 week, but if we zoom out on the 2 weeks, like if we look things at a higher time frame, then you know that like in between these two blocks, there isn't much data for us to fall upon. In other words, there isn't much support levels for us to fall upon. That means if we lose this, it's going to be a free fall. If we zoom out to look at from a higher time frame, so here we're looking at the 2 weeks. So if that makes sense. All right, so like I'm not seeing any support in between these regions before another region. So another so 70K, somewhere around that. But like if we pull up the RSI, because I'm seeing there's so many warnings, and that's why I'm one of the earliest analysts out there calling that a bear market, officially enter a bear market. All right, so even if we pull up the RSI, we are forming, so we're on the daily one, right? So this bearish divergence will actually form since May. So yeah, I mean, 6 months ago, so half a year ago, we were forming this and we're playing out rather well. And we have a downslope, a general downtrend. So that reason number 2. And reason number 3 is the RSI downtrend we are playing out as well, because this is very concerning. We are on a free fall on the RSI downtrend. Like, I'm not turning bullish anytime soon. Like, Bitcoin, first of all, we need to get above this like downtrend. Maybe we're going to see a dead cat bounce. It's guaranteed to see a dead cat bounce. Like, even though we know this is a bear market, but it doesn't mean that is a, yeah, we're going to jump straight to the 200-week moving average being 55,000. I do think Bitcoin would go to the, well, maybe 57K for the cycle bottom, somewhere around that. I don't think it's going to be very as severe as the cycles we have seen before. One reason is that this cycle is more muted compared to any cycle we have seen before. The reason why I'll do this, I will say this is okay. Maybe actually hop to the 1 week chart, then we slowly build up that time frame. So on the weekly chart, of course, we are trading below the 50-week moving average. And actually, let's close the global liquidity, because there are too many lines and I like to be organized. So we know on the weekly chart we're closing below the 50-week moving average. Technically speaking, we need 2 weekly candles to close below the 50-week in order to call that a bear market. But we don't worry, we are almost there, because today is Friday and the weekly candle going to close on Sunday, have a new one on Monday. That means we have like 2 days left. So don't worry. Yeah, we're going to get there. We're going to have the bear market. So why I think the pain is not going to be as severe as any cycles we have seen before is that for this bull market is really weird, because like technically speaking, retails weren't really here. We have a really nice pump, like we have Bitcoin ETFs that got approved this cycle, so it was really nice. But I'll argue, because like even if we got 126K as the all-time high, like the pump, the rally was like a lot more muted because retail weren't here, and it was purely supported by institutions. The reason why I would say this is because like the 200-week, we always use that as metric, like how above, like how deviate Bitcoin went above the 200-week moving average. And if we use this metric, so back in when is this? So back in October, so basically 6th of October, Bitcoin for the 200-week moving average was sitting at $53,000. And even at 126K, we were only 135% above the 200-week moving average. And this is like so much less compared to the previous cycle that we saw. So let's take a look at the previous cycle, shall we? So previously, back in November 2021, the 200-week moving average sitting at 17K. So let's take the measurements of 17K, and then we pumped to 69K. That was a 313% pump. Like we went 313% above the 200-week moving average. So yeah, I'm seeing that, of course, the returns is going to be slower. It's going to be more muted than before. But I would say like one reason for this is actually the ISM. So we know the retails aren't really here in this cycle, and this is weird. The reason being is that we know the main streets were hurting. Like if people are struggling to make ends meet, so why would they risk their money and put it into some risk on asset and some internet money, right? So that's why this cycle is different. So in a way, they were right. Like this cycle is different, and retails weren't here. And because retails weren't here, we didn't technically see a full-on alt season. I know a lot of you guys were disappointed, myself included. So let's take a look at the altcoins market right now. So let's take a look at the Toto 3. So Toto 3 is, of course, the total market cap, excluding BTC and ETH. Right now, we're sitting at $844 billion. We are, of course, still on a downtrend, and I do expect that this is going to bleed even more. And looks like the 600 billion region is very much on the table. So let's take the mid-level, right? So mid-level, I'll say $650 billion. So that is like from where we are to 650 billion. So there's going to be another 20%, at least a 20% reduction. That is my prediction for the altcoins market, because like it's just what happened in a bear market. In a bear market, Bitcoin will suck liquidity from altcoins because people will just feel really scared of holding digital assets. So the safest one being altcoin, and they will just like dump all the altcoins and go to Bitcoin. So in a bear market, altcoins will always bleed, will always fail. And even for the Bitcoin dominance, is it hasn't, like, we have been around 60%, somewhere around that, and we have been trading at 60% for a very long time. We even reached like, so in June 2025, that means just like a few months ago, we even reached 66% for Bitcoin dominance. So in a bear market, of course, altcoin is going to experience more pain. So even in a bull market, because this cycle is so different, retails weren't here. So we didn't see a alt season, and that's the problem. And that's why institutions, that's why mainstream media, that's why CNBC, they are shielding crypto so much because they're trying to get retails back in the market right now. But looking at the ISM, looking at the data, retails were never here. So like despite all the shilling, it's just like not going to move the market. And I just find it really ironic because like people keep on saying this cycle is different. Like now that so-called smart money, now that BlackRock is in the market, like we're not going to get that volatility that we have seen in any previous cycles. I can see the ROI is diminishing, and also the pain level might be getting smaller, but like yeah, it's just following what it did for any cycle. So we have the 3 cycle points before, and looks like it's following beautifully and aligned beautifully with the 4-year halving cycle. All right, so moving even okay, so 2026 I think is going to be a bear market based upon the 4-year cycle again, and 2027 is going to be slowly better. But even if we do get a bull run, maybe in 2027, I do expect that altcoins will continue to bleed. Maybe we'll have some short-lived alt season, but it's not gonna last for long. And yeah, I sound really such a bear for altcoins, because like even in a bull run, altcoins will Bitcoin will always pump first, and Bitcoin will always pump to a new all-time high. And usually when that happens, that's when we get the attention from retails, and people will start to go down their rabbit hole and go risk on and trying to gamble and trying to look for the small cap altcoins just because they think they would eventually find a new Bitcoin. So that's just how retail works. So that's the mentality of retail. So my point here is that even if we do get a bull run, a bull market kickstart in 2027, Bitcoin dominance is likely going to stay really high, and altcoins is still going to bleed a little bit and stay in a consolidation period, because like Bitcoin will shine first, and then the next one will be Ethereum, and then Solana, and then high cap altcoins, and then maybe small cap coins. So that has always been a pattern playing out. So we know that this is a bear market. We almost have the confirmation. We can confirm after the weekend. So I will be staring at the charts nonstop again, because like I'm too addicted to it. But my strategy remains: if we end up seeing a dead cat bounce, I will be okay. First of all, I took a massive profit for exposure, and from MSTL as well, because MSTL is not doing so well, but it's okay because I got in early. So even I sold, I still did okay with MSTL. So I sold, I took profit, and my strategy here for this bear market is I'm looking for a dead cat bounce, and when that happens, I'm gonna exit most of my altcoin spot positions. I'm gonna sell, take massive profit, and then I'm gonna wait for a dead cat bounce, and then maybe short some of the altcoins that I feel like is still being overvalued right now. So that's what worked to me in the past, and yeah, this is a strategy I'm sticking to. And then another strategy that I'm doing, like of course it's not financial advice, I'm just sharing my own experience, so please don't take it whatever however you take it. So the second strategy that I did is that I'm going to buy around at the 50-week moving average. So let's go back to the weekly chart of BTC. So the 50-week right now, as I mentioned, is sitting at around 50 something. So 50, 55, 56. But this line is going to slowly catch up because it's 200 week. We're looking at the really high time frame. So it's slowly going to rise up a little bit. So when Bitcoin drop near the 50-week, that is a really good spot to enter. And if by then, it might be like months later, weeks later. And by then, if I'm feeling more degen, if I have the degen mentality feeling on, I would even like borrow against BTC, because it's just like it makes sense. Like borrow some USDT and loop back into BTC. So that's some strategy I've been pulling, and yeah, so far it's working really well for me. And then the third strategy is actually JLP. I'm not sure if you guys are into JLP, or let me know, because like I love this thing. JLP, I use Jupiter quite a lot if you guys are into the Solana ecosystem. But what this does is that it's essentially is a basket of currency. So it consists of BTC, ETH, Solana, a bunch of stable coins. Like majority of them is still like, so 60% is still like BTC and Ethereum and Solana. And I think 40% is stable coins, somewhere around that. Please don't quote me of that, because I'm just like speaking from the top of my head. But some strategy I pull is to actually purchase JLP because it's just a basket of currency. And I like Jupiter because when we are betting on Jupiter, usually the house would win, right? So when people are putting long or short position, basically doing the excessive leverage, doing the degen stuff, like the degens will always lose and then the house will always win. And eventually the pile of money, the pile of tokens will get bigger and turn into JLP. So that's why I really like JLP. So when it drops, I'm gonna aim into JLP. I'm gonna pull some leverage on Camino Finance. Like I would say healthy leverage, maybe 1.5x. So yeah, that's the strategy I'll personally use. And I feel like this show is going to be very valuable and it's very, very, very practical indeed, because I don't really share a lot of these my own trading apart from looking at charts. But like, if you like it, please drop a like and comment down below. And I'm looking at the live chat constantly as well. All right, so let's also hop on the 2-week chart because we were just like spending quite a lot of time on the daily and the weekly. As for the 2-week chart, we're gonna close that 2-week candle in basically 2 days. And looks like we are, wait, are we above or we're just like, we went below the 50 MA on the 2-week candles as well, which is not nice. And we are hanging by a thread. But let's see if we close above the 2-week 50 MA or not. But like at this point, it doesn't really matter already because it's just looks like it's just gonna go down. But yeah, let's see how it goes. And because not only this, the RSI is and the 2-week RSI is, it went crazy. Like we have this like upward trend, upward support on the RSI, and we break below, and it looks like okay, we're sitting at 42k. Okay, it could maybe go down a little bit more around to 36k. So there's still some pain. Because like why I stress about this 2-week RSI so much. First of all, we have this rising support, this upward trend. And when we break this rising support on a 2-week candle, on a 2-week chart, usually that's when we know something is terribly wrong. Because like that's what happened when we, well, actually go back. So that's what happened when we drop below the support. We went to, so December 2021 or late November 2021, we had this like rising support on the RSI, but we dropped below, and that's where we know things gonna turn around and a bear market gonna start. So that's all the TA I'm doing. That's a lot of data, but like what I'm gonna do right now, let's take a little break because a lot of numbers and it takes time to digest it. So let's take a little break, and after that, we're gonna look at some Bitcoin whales who would further crash the price, and it has reflected on the chart. And yeah, he dumped millions or more than $1 billion worth of BTC on Kraken. So that's why we experience so much pain. So after the break, let's look into this Bitcoin whale's address. And also another whale being Machi Brother. He has been liquidated for more than 100 times. That's really impressive. So let's look at some degen plays and yeah, let's take a break and I'll see you guys in 3 minutes.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
So, tell us about your furry friend here. What's his name?
Oh, this? This is Bitcoin.
Bitcoin.
It's not just a cat, he's family.
Quite a name, and I must say, looks quite pampered.
Oh, absolutely. Bitcoin deserves nothing but the best. He's my little prince.
But with such a valuable pet, aren't you afraid of losing him?
losing Bitcoin. No, it never happened before, so it's not something I worry about. Excuse me for a moment. Bitcoin, stay here, right?
Bitcoin, no! Bitcoin, come on, little buddy, Bitcoin, I need you. Don't go.
In a world far away. Nah, just kidding. This story begins in this world. It all started in 1460 in Antwerp, when the first commodities exchange was created, but the real transformation came in 1602, when the Amsterdam Stock Exchange was founded. Considered the oldest in the world, it was the first to trade financial assets. Over the years, Britain expanded its colonial and maritime influence, and the British pound sterling overtook the Dutch guilder in the market. Thus, the London Stock Exchange became the financial centre of the world. The 20th century came, and the world got into some trouble. But shortly after World War II, the Bretton Woods Agreement established the dollar as the world's primary reserve currency, and the centre of the planet moved to Wall Street. Today, we're travelling at the speed of light towards a new age, an era shaped by the consolidation of Bitcoin as the currency that will define the future of the markets. We present Roxum, a new Bitcoin-denominated market that allows trading all sorts of securities, commodities, derivatives, options, and anything you can imagine. Roxum, rock-solid markets.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick, monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
Okay. Wait. Uh, yes, I just saw it from the screen. Looks like I'm live already, but anyways, as I promised you guys before we hit on that little break and I get a time to have a sip of water. Basically, Bitcoin has been under heavy pressure since October, and the price fell below 90,000, wiping out all year-to-date gains as the broader crypto market lost around $1 trillion to 1.2 trillion dollars. One of the biggest reasons behind this downturn is that Bitcoin whales are selling billions of dollars worth of BTC. Over the past 1.5 months, whales, like the investors holding thousands of BTC, have been offloading massive amounts of supply. This includes a high-profile case where a single early Bitcoin holder sold $1.3 billion worth of BTC. These sales come on top of rising macro stress and fading risk appetite and a slowdown in institutional buying, especially from MicroStrategy. So, who is this whale and why is he dumping so much BTC? So, if we check out on Arkham, this whale's name is Owen Gunden, and he sold every single BTC that he owned. So basically, a complete liquidation of 11,000 BTC by this like early trader. And this wallet has actually been active since 2011. So OG, really an OG. He sold 11,000 BTC, and the final dump that he made, it was back in basically yesterday. So he dumped $228 million worth of BTC sent to Kraken yesterday. And the selling happened in multiple phases actually. So he has been trying to dump his BTC from late October. And surprisingly enough, the dumping action also aligned very beautifully with the crash that we experienced. So we always say 1010 is the crash that happened. So it's surprisingly, it looks like it he it's very aligned with the action and also the BTC's price. So his last batch of selling happened exactly when it broke $87,000, adding even more pressure to the Bitcoin market. So why is this whale dumping so aggressively? Well, like first of all, I'm not blaming the whale for taking profit. He has every right on the planet Earth to do so because like he has been holding his BTC for a very long time. So taking profit is actually it makes a lot of sense. If I were in his position, I'll take profit as well. But like dumping $1 billion, that is like beyond my understanding, but it's fine. He should get rewarded for holding so long and have such a high conviction for Bitcoin, even back in 2011. So taking profit after it hit 126K all-time high, it makes sense to lock in a little bit with because he has a very low cost as well, so it makes sense. And as for the other reasons, I'm just like guessing what he's thinking. Okay. So macro wise, it's not looking the strongest because we know we just got out of a shutdown. What happened during the shutdown is that there's so much uncertainty. The TGA account skyrocketed to like $1 trillion. So what it means for TGA is that the government has been collecting all this tax money without spending it. So if the government doesn't spend, that means the money is not injecting in the economy. So people don't get a chance to actually enjoy that money and trigger the GDP, trigger the spending. So in other words, like the government was not spending and we had a stronger USD. So it's been reflected on the DXY as well. And we have a hawkish Fed because we know the chances of us getting a rate cut in December is not very likely. And all this macro pressure. And recently, very, very interesting news. So there is more quantum computing panic. And this was actually supported by the billionaire Ray Dalio. He raised concerns about Bitcoin's vulnerability to advance in quantum computing. He made this like debate in the crypto community. So this is what he said in direct quote. I have a small percentage of Bitcoin I've held forever, like 1% of my portfolio. I think the problem with Bitcoin is that it's not going to be a reserve currency for major countries because it can be tracked. And it would be conceivably controlled, hacked, and so on. This is what Ray Dalio said. But like I would argue, because like quantum computing, like we have seen that narrative play out for years and years. Yet it's just like crashing the market and sending all this like confusion again. Yeah, I would say I would call this a China FUD. Every single year we have some China FUD, but yeah, looks like the China FUD is not as relevant as before. And hopefully the quantum computing FUD will would do the same. But here's the counter argument for quantum computing. So if people are selling BTC on quantum decryption, they should be selling the hell of every bank on the planet. JPM should be down 20%. Every account will be hackable. BTC is SHA-256, which is tougher than LSA. So here's the counter argument, which I agree upon, because if we have quantum computer, so if the quantum computing literally gonna succeed, that means all the password, all the privacy could be broken. And when that happens, I'm sure Bitcoin will be the last thing in your mind because all the banking, all the entire world, all the encryption in this world will be broken. So Bitcoin would be the last thing in your mind. I'm sure banks would be more worried than us Bitcoin folks. So yeah, for me, for the record, I'm not worried about quantum computing and breaking Bitcoin. And let's actually go back to this whale, because the massive whale, many whales are dumping, not just one wallet. So if we actually go to this chart, it's showing beautifully. And OG Bitcoin whales are dumping. The chart is a good visual of how many super whales are cashing out of Bitcoin. All lines here are more than 7 years on-chain spends from pre-2018 era OG Bitcoin holders. So the orange line, the vertical line here, the orange one is $100 million OG dumps. And then the red one is more than $500 million OG dumps. And what this shows us, so first of all, it started in 2017. And one thing I noticed the first is that it's getting really colorful as we go to the right side of things. Yeah, we have a lot of vertical orange lines and red lines. That means a lot of whales are taking profit, especially in this cycle. And again, I don't blame them. If they're sitting on multi-millions or even billions of dollars, it's okay to take some profit or maybe purchase yourself a mansion. So whales actually typically don't sell on exchanges. Okay, this buddy here maybe as an exception because he sold on Kraken yesterday. So he sold more than $200 million of BTC yesterday. But they usually actually sell on OTC desk because if they sell on exchanges, even for the whales, when they sell, they actually the number of the value of BTC would decrease, which they don't want. They are selling a huge chunk of BTC, so they will usually go to OTC instead. But maybe this whale, this guy Owen here is valuing convenience because it's $1 billion. So who cares about that spread, right? But usually they use OTC and institutional swaps, for example, from spot to ETF looks like they're selling, but may just be portfolio reshuffling. Yeah, but it's interesting. But here's the question: who is buying all these dumped BTC? Because we know Michael's strategy, he has been slowing down on his purchases. We know the MNAV is shrinking, so that means there isn't much flexibility for MicroStrategy to buy as many Bitcoins as they wanted or they have done in previous years. But other players actually step in. For example, US institutions, so banks, pension funds, or sovereign wealth funds, they're buying via Coinbase. And there are actually other whales trying to scoop up that BTC as well. So we know in mid-November, we have another whale. So they bought 45,000 BTC. It's not 45 $1,000, but 45,000 BTC. And we also know that OTC desk, they are purchasing massive BTC. There's like a massive inflows because like OTC would always want to purchase more BTC because like during the year of ETF, of spot ETF, the OTC simply did not have enough BTC. So right now is the best time for OTC to scoop up that BTC, if that makes sense. And again, I'm not blaming on the whales for taking profit. They have every right on the planet Earth to take profit, and yeah, they have the flexibility and the freedom to do whatever they want. But since it's so perfectly aligned with the bear cycle, I think it's a good time to get in and wait for BTC to dump to the 200-week moving average. And speaking of whales dumping, there is an effect. So not only on us retails, there's an effect on a really well-known trader. So Matchy Brother, we actually talk about Matchy Brother for quite a few times on Roxham TV as well. So this bro here, he is extremely degen. He got liquidated again. So since 11th of October, the market crash, he has already been liquidated 145 times. He has lost like multi-millions dollars just since October. So that's really impressive. So my question is, how is he still so rich after getting like millions of dollars being liquidated on Hyperliquid? Yeah, I mean, I was just really curious, where is his money coming from? Because we have seen whenever he got liquidated, he just somehow managed to pull in like $100,000 or $200,000 of USDC from buying and trade on Hyperliquid and get liquidated again. So it's very interesting. So turns out, like I was doing a little bit of research, how Matchy Brother managed to stay so rich after getting liquidated for so many times, multi-millions of dollars. So Matchy Brother mainly made his money through DeFi. So he was an early DeFi builder. He involved in projects like the MITH back in 2018 and Cream Finance, but later got hacked. He also owns NFT. He's a massive NFT trader. That's, I would say, where he got his reputation from, especially in the crypto world. He also owns like at the peak back in 2021. So at the peak, he owned like $9 million worth of NFTs that include like 71 Bored Apes, those images, and 77 CryptoPunks, those NFTs. So many of them he actually bought at really high prices and later sold at a loss. So what we have seen is that he has been using his personal money, so from his personal wallet, and pulling that USDC to transfer to his Hyperliquid wallet. So in October alone, because I was like looking at these transactions, he's actually sending 200,000 USDC. So he actually received those USDC from QCP Capital, which is a major Singapore crypto trading firm. So QCP specialized in options and lending. So this could be a loan or structured financing or a partnership top up, something like that. He is also a musician. So outside crypto, he is quite well known in the entertainment industry. He was part of the LA Boys, which is a successful Taiwan-based hip hop group. He earns money from like music, from events, business ventures, and family wealth. His brother is also a well-known singer, so maybe that explains why he managed to pull hundreds of thousands whenever he get liquidated. Like at this point, I would say he is just revenge trading. Like he's not trading with his head. Because like we have Okay, let's look at another tweet. So this is extremely funny. Presenting the top 3 most liquidated degens on Hyperliquid since November 1st. Mashi Brothers sitting in number 1. He actually, he even managed to sit above James Wynn. So James Wynn, he got 26 liquidations. That is quite a lot, but Mashi Brother beat that. And the third person that we're sitting on this ranking is Andrew Tate. And I mean, I'm not surprised to see Andrew Tate. But Machi Brother is more degen than James Wynn. So very interesting. So one thing I learned is that definitely stay away from leverage. Like even though, of course, we know it's a bear market, we're heading to all the TAYs is showing that we have all the most of the indicators, most of the box being checked. Well, if I'm pulling a short in this market, I'm staying away from leverage. So maybe just short with like no leverage at all. So 1x. That's what making sense to me right now in this current trend. All right, so we also gonna take a look at the job market and so what 24 hours drag went up to almost $2 billion. So that's another evidence that we have to stay away from leverage. Even though I want to short the market, I'm not using leverage. Okay, but what we're gonna do right now before we hop onto the labor market, the job report yesterday, because it's not looking good, we're gonna take another break, and because there was like a lot of like degen stuff. So after that, we're going to look at the macro side of things. We're going to look at the labor market, and we're also going to dive deep into Japanese market. So see you guys in 3 minutes.
Security matters. Zappo Bank. The only way to bank your Bitcoin. Apply now at zappobank.com.
So, tell us about your furry friend here. What's his name?
Oh, this? This is Bitcoin.
Bitcoin.
It's not just a cat, he's family.
Quite a name, and I must say, looks quite pampered.
Oh, absolutely. Bitcoin deserves nothing but the best. He's my little prince.
But with such a valuable pet, aren't you afraid of losing him?
Losing Bitcoin? No, it never happened before, so it's not something I worry about. Excuse me for a moment. Bitcoin, stay here, right?
Bitcoin, no! Bitcoin, come on, little buddy, Bitcoin, I need you. Don't go.
In a world far away. Nah, just kidding. This story begins in this world. It all started in 1460 in Antwerp, when the first commodities exchange was created, but the real transformation came in 1602, when the Amsterdam Stock Exchange was founded. Considered the oldest in the world, it was the first to trade financial assets. Over the years, Britain expanded its colonial and maritime influence, and the British pound sterling overtook the Dutch guilder in the market. Thus, the London Stock Exchange became the financial centre of the world. The 20th century came, and the world got into some trouble. But shortly after World War II, the Bretton Woods Agreement established the dollar as the world's primary reserve currency, and the centre of the planet moved to Wall Street. Today, we're travelling at the speed of light towards a new age, an era shaped by the consolidation of Bitcoin as the currency that will define the future of the markets. We present Roxum, a new Bitcoin-denominated market that allows trading all sorts of securities, commodities, derivatives, options, and anything you can imagine. Roxum, rock-solid markets.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick. Monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
Alright guys, welcome back. As I promised you, we're going to look at some macro right now because yesterday's labor report, well, not going to lie, it's such a joke. And when it comes to the government, I seriously, everything is a scam. So without further ado, let's dive in and why I'm so pissed. So yesterday, the job report released. I mean, it's not all bad news. So, however, if you read between the lines, you know why I'm so mad. So it looks like a really nice one on first glance, right? So it added 119,000 jobs, more than expected. But if you actually dive deeper, you know it's actually the government, how it works is such a joke. And we know this report, it has been delayed due to the shutdown. It was delayed for like 6 weeks, and October one was cancelled, but at least we have the September one. But I, I mean, even we have the September one, I'm just taking it with a pinch of salt. Like this, 119,000 jobs being added, I just feel like it's such a joke. um, Okay, so let's actually dive into the numbers here, what we're looking at. September, we added 119,000 jobs. The expectation is around 50,000. But overall, since April, job growth has been really weak and has been really slow. Because if we scroll down, here in April, we have 185,000 jobs, so that's nice. But in May, we dropped down to 19,000 jobs. So that's extremely weak. How you read this data is basically 100,000 jobs per month is the metric we're looking at. That is like the average, that is like the baseline. May, it was extremely bad, 19K. And in June, we took away 13K jobs. So 13,000 jobs, it was a revision. And ever since, we have been trading. I mean, there are less than 100K job being added. And September 1, it looks really great on first glance. If we, even look at the unemployment rate. So unemployment rate, it has been ticking up. We went from 4.3% last month, so in October. Right now, we're sitting at 4.4%. So it's actually the highest since 2021. So that's not nice. And in terms of the hourly wage, so the average hourly wages, it went up 0.2% in a month and up 3.8% year over year. The picture is jobs number better than expectations. Unemployment rate is taking up. Wages are still growing. Wages grew 3.8% year over year. So it looks like the labor market is not crashing, but clearly is cooling down. But like, if we look at the actual number, like what sort of sectors are being added inside this 119,000 jobs, right? So the industry that is doing well is healthcare. So healthcare, they added 43,000 jobs. And then so as in the bar and restaurant, so F&B industry. So they added 37,000 jobs and social assistance as well. But for the industries that lost jobs, so on the downside, 25,000 jobs are lost in transportation, and then another 20,000 in professional. So business services, profession, they lost 20,000 jobs, and manufacturing. So manufacturing is actually down 6,000. So this is actually a nightmare for Donald Trump, because we know Donald Trump is trying to send the factories back to the US and trying to make the US strong again, the most powerful country, yada, yada, yada. But like, it's not reflecting on the number on the job labor market, because the manufacturing jobs has been reduced by 6,000. In simple terms, services like healthcare or F&B, social support, they're still hiring. Areas linked to goods or logistics or temporary jobs, they're weak and shrinking. The government is also slowly cutting federal jobs. This is what a late cycle labor market looks like. People still go to hospitals and restaurants because those are essential, but like factories and temporary workers, they feel the slowdown first. All right, so why am I so mad when it comes to the government and having the BLS report like this? Because the BLS always come out and revise the number. So for July they revised from 79,000 to right now 72,000. So down 7,000 jobs. Okay, I mean, it's all right. At least it's still a positive number. But in August, we revised from 22,000 jobs to a negative 4,000 jobs. So there's a net job loss. Like, can someone be that wrong? Like, can you just like throw out some random number for the jobs created in that month, and only later, a few months later, they will just revise down to a negative number? Like, are they just like, I wonder how they do the calculation. Can someone be that bad at the job? So in July and August alone combined, there are 33,000 jobs weaker than first reported. And earlier in 2025, there was already a big benchmark revision of close to 1 million jobs. So the actual number is 911,000 jobs for the year based on more completed data. What does this mean? Like, it means I don't know how the government can calculate these kind of things. Can someone be this wrong? But the labor market, at least just the data we have collected so far, just stick with this, okay? The labor market in 2025 has been weaker than the headlines first suggested. The trend is that small positive prints and then downward revisions later. That's why some people say the report is like bearish for the economy, even though the headline jobs number beat expectations. Okay, this month we claim that, okay, the BLS claimed that there is 119,000 jobs, but God knows, maybe like 2 months later, they're going to revise the number to negative, because that's how they do for the government agency. I just find the whole thing so ridiculous. But if we actually dive deeper into the number, who's feeling the pain, basically who was like the being feeling the pain of unemployment. So usually it's fresh grads, like younger people, especially with lower education, and also minorities are facing the highest unemployment as usual. Long-term unemployment is not exploding, but it's not improving either. So if we zoom out, because like this actually tie with the bigger issue, tie with the bigger macro issue that we're facing. We know there's a rising deficit in the US, but it's actually not just in the US, it's actually governments globally. So I just feel like the whole thing is such a scam. Governments are such a scam. Economy is such a scam. But if we zoom out to the government deficit, it's really important to look at this because they directly affect interest rates, inflation, and risk assets like Bitcoin. So for the deficit, we know the government around the world, they like to borrow money. So when it comes to the debt to GDP, US is sitting at 124%. Debt to GDP is like, of course, anything higher than 100% is not nice. Main drivers for this is high interest payments on existing debt. Like they spend a lot on infrastructure, on defense, on social programs, and there's also an aging population and healthcare costs. In the short term, like the US deficit, of course, they'll try to support growth, so more government spending, more demand. But in the long term, they could push the treasury yield even higher and keep the US dollar, so DXY stays strong, which would make it harder for the Fed to cut rates quickly. And this is not limited to US, it's actually government around the world. So Germany as well. So Germany is also breaking away from its traditional austerity style. So the Germany government posted a budget deficit equivalent to $134 billion in 2024, up 16 billion from the prior year. Interest payments on its debt also climbed 24% last year. There's some extra spending, especially in Europe on climate and infrastructure, because like European like to stress about the climate cause. So they spend extra money on the climate and infrastructure and some tax relief. Public debt for Germany expected to rise from 62% of GDP to 67% in 2027 or by 2027. So point being, globally, this is actually a global issue. So rising deficits in US, in Germany, or even in China or elsewhere. So rising deficit, it helped avoid deep recession by supporting demand. However, it also pushed interest rates higher worldwide. It raised the risk of debt problems in the future, and it also reduced fiscal space for the next crisis. If nothing changes, the US could face debt to GDP ratios that vary rating agencies. Europe might step away from strict rules, leading to debates over who pays for higher borrowing. But one thing I learned is that the world economy is actually more fragile than we expect. But let's go back to the report, the labor report. So what happened yesterday was that when the report launched out, because like people, if we just look at the headlines, it's better than expected. It's like 119,000 jobs being added. It looked good on the first glance, but if you actually look deeper and dive into the data, you know it's full of bad news. And how these BLS, how these government work is like, it's just a joke. Like maybe let's see 2 months later, if they're gonna revise to a negative number. That will be an ultimate joke if that happens. But if that happens, I wouldn't be surprised because it's the government. So the initial response from the stock market is that, okay, S&P 500 actually rally a little bit, and then it reversed hard. The reason why is that rate cut expectations fell. Like before the report, markets thought maybe the Fed might cut rate in December, but like since the headline labor market, it looks good on first glance. Stronger jobs mean the Fed can wait longer because they don't feel the stress of cutting rates yet. And it also pushed the so higher pressure yield and a stronger dollar would hurt risk on asset like tech stocks and crypto as well. It trigger a risk off mentality because it's not just the S&P. Nvidia also pull back. So Nvidia right now sitting at $180. So we are looking at the 1-day chart. So of course is we could see this like crash a little bit. And Nvidia basically the entire US economy. So if Nvidia drops, it's not looking good. December rate cut looks like it's unlikely. And of course, it's being reflected on poly market because like poly market is usually spot on with predictions like this. People expect that we're gonna stay constant. So 69% of people think that the rate's gonna stay constant. Only 30% of people think we'll get a 25 basis point cut. It's down drastically because like back in October, so even 28th of October, 90% of people expect we're going to get a 25 basis point cut, but like we basically dropped from 90% to right now 30%. So yeah, I'm not expecting a rate cut in December anytime soon. What this means for Bitcoin, like the labor market is not friendly in the short term because we have rising unemployment, we have delayed rate cuts. That means stronger yields, stronger dollars. So in the short term, the macro is actually really bearish for Bitcoin. It's slow, but it's not a collapsing economy. So if I had to summarize all of that in a few lines, the US labor market is not crashing, but it's clearly cooling. And together with rising government deficits and slower global growth, it creates a macro environment that is tough for Bitcoin in the short term, but potentially bullish in the longer term once rate cuts and liquidity come back. But I'm not vibing with the macro people because like they tend to think 2026 is going to be a really nice year for Bitcoin, where I still think the 4-year cycle is still intact. So it's not just like 2026 being the halving cycle of Bitcoin, but it's also the midterm election. So whenever we have midterm, there's so much volatility in the market and uncertainty is never great. So I think the bull run is going to kick in 2027. So instead of 2026, but like for now, let's just watch the job reports and also the decision, Fed meeting, some rate guidance, and also watch the bond yields very closely. Speaking of bond yields, one thing that worries me a lot because like when I saw the Japan's yield is extremely worrisome for me. Japan is a leading indicator of a global monetary system nearing its breaking point, and the US is now following Japan's path, but at a much faster pace this time. At the same time, institutions and politicians are quietly accumulating Bitcoin, signaling the insiders believe a major shift is coming. So why am I so worried? Because like looking at the 10-year bond yield chart of Japan is at a record high. We zoom out to 10 years here, essentially. So compared to 2015, we're right now sitting at 1.7%, and it's never good because Japan, it acts like a crystal ball for the US. So there are some key parallels we could draw between Japan and also the US. It's very interesting if you look at data like this. Back in 1990, so what Japan experienced is the asset bubble burst, and that was back in 1991, and US followed 10 years later. So US experienced that dot-com bubble burst back in 2001, so exactly 10 years later. And this is just one incident. The second one is that, okay, Japan started QE back in 2001, and US began the QE back in 2008. Okay, the time is not maybe not as specific as one decade as 10 years, but like somewhere around that. That is the average we could be looking at. So that is the second incident. And then the third incident is that, okay, Japan back in 1999, they have a zero interest rate. And of course, for the US, we experienced a zero interest rate that was back in 2008. So it's roughly looking at that time, that decade, so 10-year time frame. And back in 2000, Japan, the debt crossed 100% of GDP back in 2000. Yet US hit 100% in 2013 and 120% after 2020. So Japan is everything looks like the US is following Japan's lead, but Japan's 10 years ago. How we could interpret from this is, okay, Japan hit these milestones fast, and now US is repeating the same pattern, but the timeline is compressing, meaning the US may reach Japan style stagnation or crisis sooner than expected. So if we actually go back to the chart of the debt to GDP, Japan is sitting on number 2. That's really surprising, right? So 237% debt to GDP. The first one right now is Sudan, and it's a African country. It's a really poor country, yet Japan is sitting at number 2, and Japan is a really rich country. So I think this is actually not a updated data, because like if we look at the news, is instead of 237 is 290 something percent. That to GDP is right now is the highest in the world. But for decades, Japan kept the yields extremely low through heavy bond manipulation. Now those controls are breaking. If Japan, with its tightly controlled financial system, can no longer suppress the yields, because like the yields are out of control right now, then the US will also struggle, especially with higher deficits and more political chaos. The reason why we particularly need to look at the Japanese market is we know that a bunch of people like to do carry trade. Like, okay, we are in the crypto world, so we are Bitcoin folks. We might not be so familiar with the term carry trade, but basically what it means is that since the Japanese market that were basically extremely low bond, like low rate environment, and they were essentially borrowing money at a 0% rate, what these people would do is that they will borrow the Japanese yen and using that using that carry trade, using the near 0% yield, because like the cost of borrowing is close to nothing. And once they got the money, they'll actually purchase other assets, maybe purchase USD, maybe purchase, I don't know, even more risk on asset. This means when the yen gets too strong or too weak, it actually breaks global liquidity. Movements in Japan's 10-year bond, so right here, often predict the US 10-year Treasury movements 1 or 2 months later. So Japan losing control of the yield is a direct warning to US Treasury market, which anchor the entire global financial system. So that's why we have to pay really close attention to this. And what does it mean for Bitcoin, right? Like we have article like this, Japan's yield shock threatens global markets and Bitcoin might be next. So it's extremely worrisome. But maybe we could take a step back, like why Bitcoin is crashing right now. So there are a few main reasons Bitcoin pulled back and drop back to what's the price right now? So the price is $83,000 and we're still on a major downtrend. So let's go back and to see why Bitcoin pullbacks. First of all, we have the crash in October, early October, that completely shocked retail investors, completely shocked the institutions as well, because we have an ECF outflows. And liquidity actually drained from the system because we have the shutdown, the TGA account, as I covered in the beginning of the show. It rose to $1 trillion. And during the shutdown, the government didn't spend money. They were just collecting money instead of spending. So there isn't a chance for that money entering the economy. And Treasury sold a large amount of T-bills as well. But like, there's still hopium for macro analysts out there, because we know liquidity crunch is ending. We ended the shutdown, so TGA is the TGA money is slowly entering the market. Liquidity should improve going into year end. This aligns with previous patterns when Bitcoin bottoms during liquidity squeezes and rises when liquidity returns. But as for US and Japan, everything Japan did during the last decade is now happening in the US. Like, for example, Japan trying to inject massive liquidity, so trying to have this fiscal stimulus. US at the same time, right now, they pass its own huge spending bill. And as for Japan, they had this massive rate cuts, and that's why we had this opportunity for carry trade, those carry traders taking advantage of that rate cuts, that low rate environment in Japan. When we look at the Fed already cut in September and October. December, not likely, but like we know where they're heading to, and especially when Jerome Powell is going to be replaced in May 2026 next year. And there's also a liquidity injection from Japan like a decade ago. And right now, Treasury signaling that the crunch is ending. We have the confirmation from Jerome Powell, QT is ending on 1st of December. And everything looks like is following Japan's in the past very beautifully. So that's why the consequence may arrive much faster. So I would say right now, institution behavior signals a major shift. So pay attention to what they do. Insiders, like not retail, of course, are the ones quietly positioning. The US congressman publicly announced he's buying Bitcoin. Morgan Stanley moved over $100 million worth of BTC ETFs to ultra wealthy clients. CNBC, they suddenly turned so pro crypto. And when it comes to these kind of institutions, they are not just some TikTok influencers and maybe YouTubers online. They are people with insider access, people who see cracks in the system early and who lived through the crisis back in 1990s. They only move this early when a major macro shift is coming, or they need retail liquidity to push their positions higher. And I think it makes sense because CNBC all of a sudden they're so pro crypto, because what they saw is that even with the ETFs, and ETFs clients are majority institutions, so hedge funds or pension funds, they are not particularly retail money. What they need is retail money to enter, because during volatility like this, people like to say, oh, this cycle is different, but like, look at this. Like, from the all-time high of 126K to the bottom, so 82K, somewhere around that. So it's a 35% dump, 35% correction in just a month and a half. So I don't know what these people are on about. Looks like even with the institutional money, we still very much need retail liquidity. So what these insiders, CNBC, all these institutions, they need liquidity, not some ideology. They aren't orange pilling retail because they love Bitcoin. They are trying to ensure that own positions gain value. So this is how I read the news. And insiders right now, they're framing Bitcoin as a store of value, as a hedge against the falling fiat system. I mean, of course, it still makes sense. And but if we look deeper into the news, they're actually just like they need retail because retail aren't here, and it's really reflected by the ISM data. And yeah, I mean, the final takeaway from all these, like Japan and US. So Japan has already shown what happens when a fiat system reaches its limit. The US is running the same script, but 2x faster, at 2x speed. And fiat currencies cannot survive infinite deficits. Institutions are smart because they see the cracks already. They are securing the position ahead of the public. They want control of the next monetary standard. So that's why they're well positioned in Bitcoin. So Bitcoin right now, it shows like it remains to be the only asset that can't dilute or being frozen by the government or just like magically printed more because everything is on chain, and that's the beauty of Bitcoin. Retail still has time, still have time to front run institutions, but like the window is limiting. It's getting like very limited right now. I'm eyeing very close on 200-week moving average. So yeah, when that happens, of course, the first thing I'm gonna do is to break the news on Roxham TV. So make sure to give us a follow. And if you do want more our regular updates, so I advise you to follow us on Twitter. My own Twitter is jamjamcrypto_io. Make sure you put _io. Otherwise, you'll get this like hacker and scam account. So you don't want to do that. Make sure to follow Roxham TV as well, because we have regular updates about global news, about AI, about geopolitics, so everything. So you wouldn't want to miss any valuable content. As always, my show on Roxham TV is from Monday to Friday, starting at 3 a.m. Eastern Time. I know my time zone is a little bit weird because I'm based in Hong Kong, but you're welcome to catch the replay as well, because the replay is also available on both channels, so meaning my own channel, Jam Crypto YouTube channel, and also Roxham TV YouTube channel. Thank you so much, guys, for watching. I hope you have a fantastic weekend and try not to stare at the chart as much as I do and touch some grass. But thank you so much. I'll see you guys on Monday.